Welcome to TradeTheMBI.com. This is John's report is for the 4th of April. Well, we saw a little bit of that weakness expressed here from the MBI Magenta moving lower, and once it crossed below, it continued. And then we hit the declining 76% and caught support right off that. We talked about the need to fill this little setup right here, which was almost an extreme, and it did it Thursday. So Friday, a little bit of a continuation, but then that was bought up, and that's simply because still don't have that crossover of white above red, which would really signify much stronger short action within that. Dip of the shakeout, and it's still congruent within there. We're still riding with yellow above magenta in this case. Hasn't crossed over yet, but very well could. And we haven't even dipped below the buy line here, which would create the green, or even worse, if there were stronger selling, it would be into the magenta, but you wouldn't expect to see that until you got down to 61 or 50% range. And still with the declining 100% values, you still have a pressure that wants to pull up. So any pivot back up of magenta here on a daily certainly would resume an upcycle. But here you have the DOC, where red is declining, and we reach that zero when you hit the 0 point and reject. Usually expresses some weakness within that, and full reset with the DOC steel. So there's plenty of buy potential, particularly where we're still with the rising gold, and that really will hold things within a decent range at this particular stage. We're not looking at anything dramatic yet, but any sharp rise of that MBI white and or decline of red below the 10 number here, that would certainly indicate that we're going to see a much greater sell side from that standpoint. So pretty congruent to what we're expecting overall with the market. Yes, there are a lot of warning signs that we've talked about previously within the market, and you get into this situation where at a certain point from a macro standpoint, you're going to have to understand the limitations that exist within the Fed right now. There aren't a whole lot of options for the Fed. You're already spending $400 billion a year to service the debt. Every rate increase only exponentially starts to increase that debt, and then you begin to get in a situation where you're not just deficit spending, you're going to have to look to cut some things. And for the Fed to get into a normalized level to curb inflation, we just don't conceive of a way to do that without completely destroying the budget. Not that the budget for the U.S. is under control in any way, shape, or form. So you've really got some interesting problems, and it's unlikely the Fed's going to address it. And that's despite the fact that they keep talking about moving in that direction. But those bigger issues where you have a drain on available capital for the government to keeps pulling away from private sector, there's a lot of problems within that, which means back to quantitative easing, and that's kind of why you see the turnaround in the market moving up, because you just don't see any plausible alternative. Now, that's unrelated to the fact you're going to continue to see prices soar for a lot of things. Oil continues to remain elevated. As we pointed out, the euro is still in horrible condition overall. Not looking to get better anytime soon. Gold, while contained at this particular state, has nowhere to go but to the upside. Still not looking at a buy configuration at this particular stage, but you still have magenta riding over yellow, even though the pivot with white leading, that still suggests more softness within that configuration. And that's just going to be an ebb and flow, but I think long term, it's just still no question gold has a lot further that it has to rise to accommodate where things are. Oil softened just a fraction below the 100 mark here from futures contract. But it's the length of time that it's staying elevated creates longer term price instability for a lot of products. But you're going to reach a point soon with the situation of Russia and that, where even with people having the ability to buy things, you're just not going to have certain things available, particularly as some of these restrictions affect supplies of things. And where that takes us with food pricing, or you can see what's happened with fertilizer, nickel, some of these other commodities that relate to other products, you're just not going to be able to find them, which will be a unique situation for a lot of people. It's not going to be about how much you can pay for it, it's just not going to be available. And that will have further dampening effects just from a buy standpoint. And the question will become, when do consumers slow down to stop? We're already beginning to see some evidence of change in behavior as it relates to some of those things. And if that continues, becomes problematic as far as a growth standpoint and a sustainability for the market. However, that processing of the devaluation is why the market continues to rise. It's something that we've talked about for the last year plus. The market isn't going to take a hit as far as the devaluation aspect, so it's going to rise to accommodate that. But at a certain point, like we've talked about, there's a tipping point, and we just haven't reached it yet. From a bond standpoint, TLT here, treasuries, still fairly elevated, but this is still relatively high, meaning rates are still low. And that's just because you're seeing a lot more people really seeking that safety, as the market is, relatively for the first quarter down 5%, which is something people haven't seen, and that's why I posted that. I'll pick that one back up there. That's where I give you the minus 4.5. And, despite the rally, coming back from that, otherwise it would have been absolutely dismal if there hadn't been that second half rally. Bitcoin still pushing back up into the previous high areas that recently achieved after filling back in all the positive extremes and stuff. So it's pretty congruent with where it is. We had a single positive extreme that took place around 46. That was filled right back in and hovering right at that 50%, but expressing potential for a little bit of weakness. So break it at 50%. And you got to see again white moving, NBI white here moving back above red to really extend any weakness. Otherwise, it's likely to consolidate at that particular stage. And ETH, another one that I've liked quite a bit. Beautiful from its signaling. And that was the day. It started off flat to weak, built up some momentum, and then right at 50%. Nice move all the way back up. Very clean and efficient as far as that goes. Turning to the 50K, you can see that was the relative fading that had gone in, and it took the buy signals as it approached the 23%, even though you had red leading, white up there, but that magenta staying well above yellow was enough to give it that boost towards the end of the day, and it was that Friday buyers late. Early action here from a 5K standpoint saw us declining pretty precipitously. Every time we hit the 50%, continued the decline, and then it was literally all towards the end of the day. Caught a strong move. It retraced most of it again, and then right before the close, just a strong buy that pushed it back up. Otherwise, it would have been negative as well. So there's still a lot of rebalancing that's taking place within the current setup, and we're going to get this back and forth, which I think the volatility is excellent as far as what we look for, because it's more standardized mean reversion, meaning you get your spikes pulled back into it, and it's just a matter of following what the readings give us from a MBI DOC setup. This was pretty clean from that buy setup, but that was going to be a strong continuation. Did produce positive extremes within it. So expectation for fillback is going to be right around to that 45-24 range. We'll look for that, see if it takes place in the pre-market setup or if it takes a little bit longer. We'll be able to recognize it. And, all pretty consistent from that, but some of the bigger questions, macro-wise, really going to be tough to navigate because they're new. They just haven't existed before. A situation where the Fed is pretty well crippled as far as what it can do for rates. All it can really effectively do is pull liquidity, and the best way for that to take place would be to create a bit more market gyrations to tie up funds, help force them into non-volatile assets, which would be, of course, treasuries, is what they really want people to convert back into. And that isn't really addressing anything as far as it relates to the inflation. You see no effort whatsoever to really combat that. And I give releasing the petroleum reserve and stuff like that, those are very short-term mitigations that without a longer-term prospect aren't really going to do anything. It's just about trying to give the appearance that they're making an attack on, which broad strokes will do fine for the market short-term. The real issue is going to become how prolific these supply disruption down the road and what that's going to mean as far as companies not being able to actually sell enough of the products that they have to have an impact. So we will definitely be keeping close watch on all those things, but doom and gloom may be on the horizon, but not yet. So we just have to play the market that currently is. So as long as it's able to find relatively cheap money to buy additional, they're going to keep buying dips in that. So it's not one of those where you just, say, oh, everything's a disaster short, run away from it and don't do anything. I think that there's plenty of plays to be made both long and short throughout this period. So that's what I would be looking for going forward here. As always, though, I will continue to update you on the Skype chat. Trade well. We'll talk to you later.